Australia's economic emperor embraces fanatical extremism. Martin North. John Adams, in Interest of the People. Hello, John.
Hello, sir.
Who could we possibly be talking about?
The emperor who has ultimate political and financial power in this country and who reigns without any form of accountability, and he is able to do whatever he wants, whenever he wants. And I would say that what we saw last week from the RBA governor is the equivalent of the madness of King George III. It is the most extreme monetary policy package announced in the history of Australia. And we're going to go through the elements of that package. The RBA governor says that he has more firepower if required. And the key message from today's show is this is going to do enormous damage to the economy. It's going to do massive damage to the Australian dollar, in my view, and in the purchasing power. And I think there's going to be an inflation problem that will exacerbate going into next year. But the most concerning part of this, Martin, is we can never come back. Because what we'll explain to the audience is that this whole policy set that the RBA has announced is designed to protect the bubble. And if you start to reverse any elements of this package, you're going to start to damage the bubble to the point that you'll have a systemic deflationary crisis. And so in order to stop Harry from being correct, so remember, Harry has said consistently, deflationary crisis, the bubble implode. The bigger the bubble gets, the more dangerous the bubble becomes. In terms of implosion, the more radical and extreme they have to be to stop Harry from being correct. And what we saw last week is like I said, the most radical announcement in the history of the country.
Yes, and then from that high castle in Martin Place, the RBA governor can look out over all his people and just say, we're going to do this, right? The fact, of course, is that he's following the same playbook as the Fed and the Eurozone and the Bank of England. So it's not like he's being very innovative, but nevertheless, the implications are profound and very worrying.
Indeed. And just to give a bit of historical context for the audience. So last year we did 2 shows about the economic emperor.
Yep.
So the first one was called The Economic Emperor Will Crush You. And that was when I think they lowered the cash rate to 1.25%, and there was an indication that they were going to more extreme policy settings. And people can go back in our YouTube history to find that show. And then we did a show in November last year called Australia's Economic Emperor Will Unleash Monetary Madness. And this was in response to the RBA governor's speech to, I think, the Australian Business Economist, where he actually explained his views on unconventional monetary policy. Now, it's important to note that next week, the RBA governor is scheduled to give a new keynote speech about the future of monetary policy. And so no doubt we'll be keeping an eye on that speech and saying, well, this is what he said 12 months ago. Here where we are today, where the most radical policy package announced. And obviously he'll be flagging perhaps even more announcements next week for 2021.
Yes, and interestingly, the Reserve Bank in New Zealand have announced that they're not going to impose further capital imposts on the banks over there. And they are now fretting about the housing bubble that they've created and the fact that they're now wondering about whether they should inject loan-to-value ratio caps back into the system because they took them away, right? So they're getting nervous in New Zealand. And of course, New Zealand tends to be ahead of the curve, right, relative to Australia, because the Reserve Bank in New Zealand went through the same process some time back. So I don't know what we'll find from Mr. Lowe next time he speaks. But the fact of the matter is, John, we were calling this out 18 months ago. We knew what was going to happen.
Indeed. So we did, particularly about the RBA. Now, over the last 2 to 3 months, where on this channel we've been talking about stagflation in terms of rising unemployment, low to negative economic growth, and rising prices. One of the things that I flagged was that because of political pressure, because of democracy, because of how much political capital from the politicians to the economic institutions to the banks, the media, etc., has been invested in this bubble, that if we get into October, once the cuts to JobKeeper and JobSeeker reduce, if that results in a weak economy, I was expecting more stimulus to be announced even after the budget. And obviously there was a number of stimulus measures announced in the Frydenberg budget in October. So here we are in November. Now, one of the things that I thought we would see is some sort of reversal on JobKeeper and JobSeeker. And this week we saw a reversal on JobSeeker, which has been extended to March, as opposed to ending at the end of the year. So we didn't flag in our previous conversations that we would see an extreme radical monetary policy package from the RBA. But what we did note was that a number of central banks, like the Reserve Bank of New Zealand and the Bank of England, did say that they were looking to inject more quantitative easing before Christmas. And lo and behold, we have, to a lot of people, the budget was the sort of end of the road of the COVID-19 stimulus, and October has come and gone, and we're now seeing obviously more stimulus from Canberra. Now, it's interesting about the state and territory governments. So the Western Australian government has announced their 2021 budget with a whole host of sweeteners going forward for 2021. Northern Territory has announced their budget. Yesterday, South Australia announced their budget. And then we're talking record debt at the state and territory level. And then we have a number of announcements. Tomorrow we will see Tasmania announce their budget, and over the next few weeks we will see announcements from New South Wales, Victoria. ACT will be next year, and Queensland has committed to a budget to be announced before the end of the year, but we don't have a specific timetable on that. So we're going to see more stimulus coming at the state and territory level. And obviously, in a previous show that we talked about is there is this suggestion that part of the QE program from the RBA is to help monetize state government debt so they can inject more money into infrastructure. And that was actually one of the key announcements in the South Australian budget about more road projects to actually reduce congestion in the city.
And of course, APRA has announced the end of the committed liquidity facility, and it's going to be replaced by a facility that basically can include state debt.
Yeah.
So it's all part of one seamless package of ever more stimulus, ever more debt. But of course, the question you've got to ask yourself is to what end?
Indeed. The other point I think it's important to note, Martin, is that so obviously we have been told by the mainstream media and the government that we have seen the worst of COVID-19. We're starting to open up the economy after the so-called Victorian second wave, and that as we go forward, as the economy opens up, as life comes back to normal, things will improve in terms of economic prospects into 2021. So a couple of points to note is this morning Westpac announced their latest consumer sentiment data, which actually says that sentiment in November 2020 is much more rosy compared to 12 months ago. So it seems that the public, assuming the Westpac data is accurate, and I think you may have a view because your data set may be slightly different to the Westpac data, but assuming that the Westpac data is accurate, it seems that the propaganda from the mainstream media has convinced enough Australians that going into next year, things will be quite good in terms of the economy. And yet, if they were really going to be that good, we wouldn't be seeing the most radical policy package being announced by the RBA. So I would say the fact that we've seen a whole host of additional stimulus measures, more radical post the Frydenberg budget in October, this is a signal to me is that the economists within the government are actually nervous about 2021 as opposed to thinking that 2021 is going to be a fantastic year for Australian economic conditions.
I agree with that. So my own surveys, the household financial confidence index is up a little bit this month, but nowhere near as positive as the Westpac sentiment survey. So I don't know whether sentiment and confidence is the same or not. It depends on your definition. But the Roy Morgan ANZ one is also closer to mine rather than to Westpac. So I think the Westpac data is a little bit of an outlier. But the other point is dead right. If things are going so rosily and everything is coming back to normal, why are we throwing all this money at it?
Absolutely.
Words and figures differ.
Yes, and you know, one of the things that we have talked about in terms of what one of the previous shows is we've talked about the growth of broad money and how that is in terms of escalating. Well, you know, if you look at the recent RBA data for September 2020, it is at the highest level of growth since October of 2008. So we are seeing huge amounts of money being pushed into the system. And funny enough, you broadcasted on Walk the World this morning an interview with Peter Schiff,
yes,
who said that all of this central bank action, whether it's Australia or around the world, will lead to a more inflationary environment, which is consistent with my perspective, Lynette Zhang and Jim Rogers and a whole bunch of other sort of people on the inflation part of the debate.
It's also worth noting, John, that 12% broad money should be compared with 2% credit growth on an annualized basis, right? It's as low as it's ever been. So one of the interesting questions is all that money, it's not going into more credit, which is a fascinating diversion.
Yes, and that's probably something that we will get into in a future show, because I've been looking at the history of broad money and various points in Australian economic history, and there is a very interesting story to be able to tell on that point. But going into the specifics of the package, so let's actually put slide 1 on the screen. So basically, the key announcements by the RBA last week was they reduced the official cash rate to 0.1%. And when we talked about the economic emperor going crazy in mid last year, the cash rate was reduced to 1.25. So we're basically close to zero. And assuming that, now, again, in terms of negative interest rates, the RBA said we don't think it's a good idea, but he has now hedged his position. He said if other central banks go negative, we will follow. And so negative interest rates can't be ruled out. And obviously, if there is any adjustments on the cash rate, it will have to go negative. Now, at the beginning of the year, so in March of this year, as part of the COVID-19 monetary stimulus response, they said they were going to implement what they effectively yield curve control by targeting a interest rate on the 3-year government bond at 0.25%. They announced last week they're going to reduce that from 0.25 to 0.01%. Now, the term funding facility, which is basically they've printed up a facility worth of $200 billion and said to the banks, rather than you borrowing on the international credit market, you can actually get a cheap source of funds. The interest rate they're willing to charge the banks is only 0.1%, which is obviously dramatically lower than what they could actually get in terms of the international market. But I should say, and if I'm wrong on this, Mark, feel free to correct me. I was reading about this yesterday. The term funding facility is, I think, about 2 to 3% of the bank's portfolio, and this is designed to help the banks facilitate lending to the business community.
Yes, it's meant to be targeted, but of course the overall funding mix is what the bank is thinking about. So essentially what they're doing is replacing some of their higher cost bonds, particularly overseas bonds, with this lower funding source. So their overall cost of funds are being reduced by it.
Yeah. Now, the fourth announcement they announced was around, at the RBA, they have the commercial banks have accounts called exchange settlement accounts. So when the RBA buys bonds, government bonds when they buy these bonds, they're buying them from the commercial banks. They deposit money at these accounts, and these accounts called exchange settlement accounts, which are at the RBA. So previously they were charging a minimal amount of interest to the banks. Now they're saying to the banks, we're going to pay you zero interest. And obviously if there's zero interest, effectively what they're signaling to the banks is, we don't want you to hold any money in these accounts, get the money out and get it out into the economy.
Yep. Lend, right? Which is why that 2% growth on credit is so critical.
Yes.
Because what it means is the banks are being given a fire hose of liquidity, but it's not actually going to the real economy.
Yep. Now, the last thing that they have announced is they've announced a $100 billion QE program targeting 5 and 10-year bond maturities for the next 6 months. Now, we will talk about this in some detail in a future show, but I've had some correspondence from the RBA where they've explained to me the difference between quantitative easing and yield curve control. So basically, if the RBA is buying bonds at a particular price, at a specific defined price to generate a yield at a specific interest rate, that is yield curve control. If they're buying bonds at any price because they're just trying to lower interest rates across the board in order to generate economic growth, that is quantitative easing. So indiscriminate buying, according to the RBA's definition, is QE. Specific targeted buying is not QE. It is now, they don't call it yield curve control, but a whole bunch of international publications effectively have said that is what it is. And there is some evidence that during World War II, the US Federal Reserve did actually engage in yield curve control, where in order to help the United States government fund the war effort, they did actually buy bonds at specific, I think for the 10-year US bond rate, they targeted a specific interest rate to basically drive down interest costs so that the government wouldn't have a huge interest bill as they were fighting a war on two fronts.
Yes, and that's the point. And the old adage about if it quacks like a duck, it's probably a duck. Well, I think this artificial distinction between quantitative easing and yield curve control is just rubbish. It's all part of the same program.
Well, yes. So I definitely would agree with you, but it was interesting as I was having this back and forth correspondence with the RBA, how the person who was writing to me saying, no, there is a difference at the RBA's thinking, and it's important to note that there are two ways to buy bonds, where you just buy. So for example, it could well be if you're going shopping, you just want to buy tomato sauce at any price because you just need it, or you're going to buy tomato sauce if it's at a specific price point.
Yep. No, I understand the difference, but I have to say I think they're making an awful lot of those two significant distinctions, which look very, very similar to me. But it's also worth saying, of course, they're operating in the secondary bond market, right?
Yes. And the other thing is that, and this was announced in the Statement of Monetary Policy, 80% of the bond buying is Commonwealth bonds and 20% is state and territory bonds.
Yes, absolutely.
Yeah. Now, the question obviously is well, why are they doing all of these sort of radical announcements? Now, the statement released by the RBA in terms of their official decision, they had a specific paragraph that caught your eye. And let's put this on the screen because this sort of really sums it up. It says, quote, "The combination of the RBA's bond purchases and lower interest rates across the yield curve will assist the recovery by lowering financing costs for borrowers, contributing to a lower exchange rate than otherwise, and supporting asset prices and balance sheets." Now, to my mind, as an economist, the first thing I hear is, so when we think about balance sheets and we think about asset prices, we're talking, well, these balance sheets around the country, household balance sheets in particular, are basically drowning in debt. And asset prices, obviously, when you look at residential commercial property, it is sky high. So when the RBA is specifically saying we are supporting balance sheets, what that means is we're going to stop the debt bubble from imploding because what's on the balance sheets, it's debt. And obviously when we support asset prices, we're not going to let asset prices collapse. So obviously, I mean, because this was the intent, and I could see the amount of stimulus that was coming down the pike in the March announcements, that's why I was confident that when we did the show several months ago, and I said that the house prices would not collapse in the next 18 months, I said they will fall, but they're not going to fall by 40% because of how radical their commitment is to keeping this in terms of the debt bubble going. And obviously, in terms of lowering the finance costs, I mean, that is not only to help existing borrowers on a cash flow basis, that's also to provide incentives for future borrowers to actually enter the housing market to actually buy more property and to keep this bubble going. So that's what they mean on that front. And obviously in terms of lowering the exchange rate, so there is a view among central bankers that you can promote exports by having a cheaper dollar, and having a cheaper dollar will actually generate economic growth. Now, there have been a number of economic studies which have effectively, proven that to not be true. So all this does is, so in the short term, you may get a couple of quarters of export growth, but the consequence of this is that you get an inflationary impact, which actually ruins your domestic economy. So I don't buy this argument of, in terms of having a lower exchange rate and that's going to have economic prosperity. And in your interview with Peter Schiff this morning, he specifically made this point that you have better prosperity if you have a stronger dollar because you have greater purchasing power.
Absolutely. And it's also worth noting, John, that when all the central banks are trying to lower their exchange rates, right, everybody's playing the same game. So net, you may not get any differential advantage. And of course, in fact, now the exchange rate is about 73 to the US, right? 71 when he made the announcement. That's gone the wrong way since he announced.
Indeed. So going into 2021, there should be no conspiracy theories around the cost of living. So if people say the cost of living is I'm really feeling the cost of living, people should just ignore the CPI and basically say, well, the RBA has said we're going to support balance sheet, we're going to support asset prices. So if you're a first home buyer or if you want to upgrade your property and you're scratching your head thinking, why are things so expensive? Well, the RBA, so there's a lot of conspiracy theories, particularly on the internet, about, central banks have specific hidden agendas and, they're going to have, in terms of the Great Reset, Nasara, Jassara, all of this sort of stuff. We can park all of those various hypotheses to one side because the RBA has been explicit in their own words saying we are supporting balance sheets, which is we're going to stop debt from imploding, and we're going to support asset prices, which is to say that these house prices we're going to push them up as high as we can.
Yeah, and of course, John, there's a contention here between what the Reserve Bank is trying to do through its monetary policy and through its quantitative easing, and the fact that many households are experiencing higher unemployment, lower wages growth, higher real cost of living already, right? So it'll be interesting to see which side of the equation ultimately wins. Will it be the Reserve Bank and its policies, or will it actually be the real felt experience in the real economy?
Well, that real world experience that people will feel, that is going to be the stagflation. So next year, so we're already seeing it this year, but next year you're going to see sustained higher unemployment, underemployment. Even if you've got a job, you're going to have lower income compared to pre-COVID, and prices are either going to be the same or they're going to be higher. And the reason why this is going to confuse a lot of Australians who have an economics degree is because the Keynesian macroeconomic model says that a recession is created by a reduction in demand, and when you see a reduction in aggregate demand, it means that prices should fall, and prices next year will not fall, even though we are still in a recession. And people are going to say, well, why is that? The answer is it's stagflation.
Yep. And the bank did it.
Yeah. Well, yes. Like that is absolutely correct. So central banks have played a central role in this squeezing of middle class in terms of economic conditions and their future prosperity. But I would also say that the role of the private sector, the commercial banks, as well as in terms of fiscal policy, that has also played a part in this phenomena that we're going to be seeing going forward.
Absolutely. Yep.
So now, Martin, obviously the question is, well, we've talked about the package. We've talked about what's the RBA trying to achieve. So then obviously what are the implications? And so I think the implications are profound. And we there are a few implications. So, and we just touched on that in terms of, I believe going in next year, stagflation will intensify, and that will mean that Australians will struggle in terms of getting by. Particularly, there are some, when you have an inflationary environment, there are some vulnerable groups, particularly those on fixed incomes, the elderly, in terms of the young.
3 million savers.
Yes, absolutely. If you're holding Australian dollars, particularly in the banking system, you're not going to get a rate of return that's commensurate with in terms of the increase in terms of prices, and means that people's living standards are actually going to go backwards. So that's obviously one of the big implications. Now the other point is, and we said this at the beginning of the show, is we cannot go back, and now the reason why we can't go back from a policy setting is twofold. The first thing is, whether it's yield curve control or quantitative easing, the purpose of this policy is to push bond prices higher to get the bond interest rates down. Now, the way they have done this is by printing money and bidding the prices up in order to get the bond prices down. And they're doing it in a way that they're doing it artificially. And there's not enough private sector demand to actually get the prices to the level that they want to achieve. Now, when it comes to the point that they ever wanted to reverse the quantitative easing, to go to quantitative tightening, or to stop this yield curve control, when they sell the bonds back into the market, because they've artificially bid these bond prices up, there is not enough private sector demand to sell them into the private market and to keep the prices as they are. So if they ever did quantitative tightening, bond prices would fall, the interest rates on the bonds would rise. It could be quite sharp, and then it will reach a point where you're going to have a crisis in the market, in the financial markets. And that's actually what happened with the US Federal Reserve going into December of 2018, where they were stopped. They were doing quantitative tightening for a couple of years. They were starting to raise interest rates, and they were projecting for 2019 that the rate rises would continue, and that was obviously causing concern about deflation in the share market, and the share market started to tank, and then basically Jerome Powell had to reverse. So that's why I've said for more than 12 months, once you start QE, you can never reverse it because of the implications. So that's about the bond purchasing. Then the other obviously important aspect is in terms of interest rates. So a lot of borrowers, even in terms of mortgages. So we know from in terms of mortgage brokers, and I have some contacts, and obviously you've got some contacts as well. We're seeing a lot of activity in the market now about refinancing because people want to have mortgages in terms of cheaper rates. And we're seeing a lot of activity. Not a lot. We're seeing some activity where new buyers, first home buyers, are coming into the market and obviously trying to stamp up property at a particular interest rate. Now we know that 70 to 80% of the market is on variable interest. If they started to raise rates, even from these very low levels, it means that in terms of mortgagees, they're going to start to see rising interest costs. And I think for even if 2021 tends to be a strong year, I don't think a lot of households could handle interest costs at, that are a much higher level, because even with your mortgage stress data, I think stress is at 40.6%.
Correct.
And and this is where 46
with current low rates.
Exactly. And so if they started to raise rates, who knows? Maybe we see stress at 50% or 60%. So they've boxed themselves in. And obviously the other thing is that the implications of what I'm about to say haven't fully come to a head yet. A lot of this QE, a lot of this yield curve control is to help governments produce these large deficits. Now, if they started to reverse some of these policies, what this would mean is that the interest costs for governments would start to rise quite sharply, and you would see huge solvency problems for state governments in terms of the federal government as well. So you could really see a big problem in terms of households, in terms of the banks, in terms of pushing the funding costs, and also in terms of government. And so that's obviously why I'm concerned, is where we because we have gone to this extreme measure, this extreme position. They've said that they're not out of ammunition; they're going to go even more extreme, and we know they can't go back. A couple of points. One is, I don't, it's more unlikely that the Harry Dent scenario is going to play out because of to the lengths that they're willing to go through. But the ultimate consequence of this radical monetary policy is the purchasing power of the dollar, which goes back to our third show that we did back in 2018. We know for 1,000 years when you have a fiat currency and you print it to oblivion, you basically it goes back to its intrinsic value of zero, and this is what we are seeing. And typically, in the history of currencies, a typical fiat currency could last 40 to 50 years. And once you get to the end of this 40 or 50 year cycle, the amount of growth of money to keep this currency in play, it goes up exponential. And this is at the point where we're getting up now. So there's a lot of commentary about when some people out there are saying when they talk about the Great Reset or a reset of currencies, it's that these government currencies are going to basically collapse in value, and we're going to move to some sort of new international currency. Whether and obviously this is where the Jim Rickards conversation sort of in some of his books talks about, in terms of the IMF, in terms of the special drawing rights, whether that's the new monetary standard, or Peter Schiff will say gold, or some people say maybe Alex Saunders will say Bitcoin. So there will be some sort of monetary realignment because of this consequence, and that will be a tumultuous episode when we get there, and we don't know exactly when we get there, but I think we've reached the point of no return, and that will have quite damaging consequences for our audience over the next 5 to 10 years.
And the point really, John, is will central banks ultimately get to the point of saying it's not working, we have to do something different, right? Will they just go on doing more of the same, as you say, exponentially, to try and actually sustain this process for longer? I mean, the Fed's been out for 10 years plus, hasn't worked. Why would it work now? Definition of insanity is continue to do the same thing and expect a different outcome. And then that begs the question then, so will there be a disruption, a discontinuity in some way? And if so, what sort of discontinuity would it be and what the implications are? We don't know yet, right?
No.
But what we do know is you can't go back from where we've actually got to. It's effectively a cul-de-sac. And I wish somebody in that Senate estimates had asked the Reserve Bank about exit strategy, right? I haven't seen anybody anywhere ask about the exit strategy, and for me that's a major issue.
There is only one exit strategy ultimately, and that is to knowingly collapse the debt bubble, knowingly saying we're going to have a deflationary depression. So if, for example, and we talked about it in our last show, the 10th Prime Minister, Joseph Lyons, he explicitly said austerity, we're not going to inflate the pound. We had the pound at that time. We're going to reduce these government debts, and we're going to reset the economy on a more solid on a more fundamental financial basis. If we had a political leader who said we are going to knowingly, consciously go into depression, we're going to collapse the debt, we're going to raise interest rates, we're going to restore faith in the currency, that is the only exit strategy. Now, the current political leadership have no appetite for that. The Australian people have no appetite for that. That's why I said in our last show that is the correct path. And if we go back to our show 2 years ago with Sean Quinn, we said, you famously said, alt control delete.
Yep.
We need to have recession, depression, compression, whatever the term you want to put on it, and we need to bite the bullet and actually try to get the economy on a more solid footing. And there's only one person who did it, and that was Joseph Lyons back in 1931.
So he'd be turning in his grave at the moment, wouldn't he?
Yes, absolutely.
John, I appreciate your time today. Very important episode, this. We'll continue to watch and monitor what the Reserve Bank continues to say, but I think the bubble is being inflated further, and there's no way back.
The economic emperor is in the bunker, not listening to any sane advice, and we are seeing madness that we've never seen in 200 years.
Yeah, you're right, John. Martin North, John Adams, Interested People. We'll see you next time.